Hi, Bill Ham here, and I'm going to answer the question, when can we refinance our real estate, commercial real estate? So we're talking about an income producing property such as multifamily. I see this being a problem in a lot of people's underwriting. They actually don't know when they can refinance, and so they plan on a refinance much sooner than is actually applicable. So today we're going to talk a few different points, and I'm going to show you a few different calculations that we'll be able to use to decide when can we refinance our deal. All right, so number one, we're going to assume that you are probably trying to pull money out of your deal whenever you go and refinance, right? So let's say we put 100% of the purchase price. All right, we'll just say for conversation's sake, that's $1 million for our apartment complex. And we've put down $200,000, which would be 20%, right? And we borrowed 80% from the bank. Just keeping the math simple, that would have been $800,000, okay? So we want to borrow, what we want to do is we want to refinance this property in the future and to be able to pull out the $200,000 that we put in as down payment and get this back. If we can do that, that gives us an infinite rate of return, and that's a great business model. A lot of people call this the BRRRR model, the buy, renovate, refinance, and run away, or repeat. I forget what that stands for, but buy, refinance, repeat, and repeat some more. So anyway, it works, but not always. And so what I want you to understand is, when can we actually pull this model off and be successful with it? So again, for today's conversation, we're going to assume that we bought it at $1 million, we borrowed $800,000 from the bank, and we have $200,000 in the deal ourselves, and we're going to ultimately want to pull that $200,000 out of our deal. Okay, we have several different answers as to when can we refinance. Number one, we have what's called seasoning period. All right, so that is seasoning, I'm not very good at spelling, seasoning period, if you can read my handwriting there, seasoning period. Okay, that means how long we have to own the property before the lender will allow us to refinance based on a new appraisal and not the original purchase price. Okay, so whenever we buy real estate, or whenever we go in for a loan and we want to get a loan on real estate, a lender is going to give us the loan, or what we call LTV, loan to value. They're going to give us this loan to value based on one or two numbers. It's either going to be the purchase price or the appraisal, whichever is lower. Normally speaking, you obviously hope that the purchase price is less than the appraisal. So whichever is lower, then that means you're going to be putting down 20% of the purchase price and borrowing 80% of the purchase price. Yes, as long as the appraisal is more than the purchase price. If the appraisal is less than the purchase price, number one, you're making a mistake on that deal. Number two, you would be then borrowing 80% of the appraisal, right? Not the purchase price. So that's just a quick understanding of loan to value. You're going to be borrowing against the price, hopefully. All right, so again, in this particular scenario, we're trying to pull out $200,000. When can we get our $200,000 out? Number one, after the seasoning period. The seasoning period, rule of thumb, not a law, rule of thumb is anywhere between 12 and 18 months. All right, if you have bought a property for the $1 million, and you want to pull out the $200,000, we have to own it long enough that the bank will look at the new appraisal and not the original purchase price. If you try and refinance too quickly, but within that seasoning period, chances are the lender is going to fall back to the original purchase price plus whatever cost of renovations you've put in that property. So if I bought it for $1 million and I put $100,000 into renovations, they're likely to only use $1.1 million for that loan to value number, and they're not going to let me cash out. Okay, but I want to cash out. So what I've got to do is probably wait the 12 to 18 months for this deal to season. Once I've owned it for, let's just say, 18 months, then the lender will go and say, okay, we'll ignore your original purchase price. What we're going to do, we'll pull an appraisal, and we'll find out what the thing's actually worth, and we'll give you 80% of the new appraisal, which is what we're after, because we've probably gone in there and done renovations on the property and forced the value up, right? So if we started off here and here's our value, and then all of a sudden we do renovations here and our value jumps up like this, we want to use this as our new appraisal amount to borrow against, not the original purchase price. So we need this money to jump up. We need the value to jump up so that we can borrow against the new amount. And we also need to make sure that this is enough time for that. So this is that 18-month seasoning period, right? And this is our new appraisal up here. So that's going to be our new appraisal. All right, so how much of an appraisal do we need to have? About 30%, all right? You need that property to go up in value about 30% for you to be able to pull out your 20% and to have fees in there. So you got your closing costs, your lender fees, things like that. And that's where I'm using this roughly 30% number. You're probably 25% down payment plus some fees. So number one, now what we're saying is we need this property to go up to our $1 million property now needs to be worth $1.3 million after 18 months. So $1.3 million in valuation. This is our appraisal, and this is going to be after about 18 months. So we have our seasoning period, and we also know that the property needs to jump up in value relatively considerably, 30% or so, for us to bring that appraisal to the table and to be able to borrow of the 1.3, 80% of the 1.3 gives us back our 200 grand, 1.3, 1.4, give or take, and that's how we'll pull our cash out. Okay, so now we have to decide, can you make this jump in value in 18 months? You know, making a property go up 30%, and let's just say now it's 2 years, making a property go up in value 30% in 2 years is 15% appreciation a year. All right, what I would recommend is that you stop and take a look at the general appreciation rate in your market. If you see that the general appreciation rate has been 5, 7, 8% over the last few years, and you're expecting it to go up 15%, you're being a bit aggressive. Okay, so what that's going to do is it's going to lengthen the time. It's not to say that this won't go up to 1.3. It's just not likely to go up to 1.3 in an 18 to 24 month window. It's probably going to go up more like maybe 3 years or something like that, right? So understand you need a 30% jump in value and to be able to pull this out. And that's going to happen over 2 years or so. 18 months, probably being a bit aggressive there. So that's one way we look at it, all right? The other thing that people tend not to pay any attention to is what we call debt service ratio or debt service coverage ratio. And you will see that debt service coverage ratio. Debt service, that's a fancy way of saying mortgage, all right? So what the debt service coverage ratio means is how does our NOI, our net operating income, which, sidebar, remember net operating income is income minus expenses. That equals our NOI. We use the NOI to pay the mortgage, all right? So the debt service coverage ratio is the ratio of net operating income to loan payment. So if I am at a 1.0 debt service coverage ratio, am I making money, losing money, or break even? I'm break even, because that means for every $1 of net operating income, I have $1 in debt, so I'm dead even. Lenders don't like that. They really want to see this thing's probably going to be something closer to 1.2. So let's get rid of that. Let's go back over here. We're going to do 1.2 or maybe even 1.25 if we're going with agency debt. Debt service coverage ratio. Okay, so now the calculation is we've got to figure out how much NOI do we need to get to a 1.2 debt service ratio on the new valuation of $1.3 million. Whoops. So keep in mind that that's going to be, if we now got to get that valuation of 1.3 million, you need a DSCR of 1.2 or 1.25 on the $1.3 million. Okay, that means the NOI that we have today, right, has to increase a fair amount to be at a 1.2 0.25% of 1.3 million. You're probably going to have to raise the net operating income a fair amount to actually come to this 1.25 on the new debt service ratio, or the valuation of $1.3 million. Okay, so what we're doing here is now we're saying that we have seasoning period, 12 to 18 months. Within that 12 to 18 months, we have to jump the value of the property 30%, and we have to increase the net operating income enough to qualify for the refinance. It doesn't matter if all the neighbors are paying more in real estate, but you have not increased your revenue, you won't qualify for the mortgage because you'll be less than that 1.25 debt service ratio, and you're not going to pull any cash out. So those are your three areas that we've got to make sure that we have. Now, when we're talking about net operating income and debt service ratio, here's the formula. You take the new calculation. So what you got to do is you got to say 1.3 million. Okay, let's figure out what NOI gives us that 1.25 debt service ratio. What is the difference or the delta between today's NOI and tomorrow's NOI? Okay, so we have to buy the property. So there's our NOI today. What's the NOI got to be tomorrow to hit that 1.25 debt service ratio? And we want to subtract tomorrow's NOI from today. All right? So what's the difference is what I'm saying. All right? Let's say that this NOI now has to go up $100,000 in order to qualify for the new loan at that 1.3 debt service ratio. So we're just using quick math. I'll just say, you know, our NOI has to go up $100,000 in that 2-year window to reach the new debt service coverage ratio. Fine. Now what we do is we say that's the difference between the old NOI and the new NOI. We're going to divide that by the number of years that we want it to take to refinance. So if we're talking about refinancing this property in 2 years, we know now that we have to have $100,000 increase in our net operating income. Divide by 2, that's $50,000 a year that we have to bring that property up in occupancy or up in revenue, right? So that's it there, $50,000 a year. Okay, so now you're saying, all right, mathematically speaking, I have to raise the rents and keep the expenses steady for 2 years, and I've got to increase the revenue on this property $50,000 per year. Okay, now another head check. What we want to do is to say if we need $50,000 a year. So we'll start back over here. We have $50,000 a year that we've got to increase the revenue by. Divide that by number of units. Okay, so if we're talking multifamily, let's say this is 100 units. That means we would have to bring the revenue up $5,000 per unit per year. Okay, so now we're really getting granular here. We're going to take that delta between the original NOI, the future NOI. How much is that? We'll say 100 grand. We divide that by number of years. 2 gives us 50 grand. Now take that $50,000, divide by number of units, and that will equal how much rent growth you have to have each year per unit to maintain or to get to your goal. This is the head check right here. I want you to pay attention. If all of a sudden you realize that this is raising the rent per apartment $300 or $200 per year for several years in a row, that's going to be aggressive. You know, it's not to say that you can't raise the rent, and it's not to say that you can't ultimately get that valuation. My argument is it's probably not going to happen as fast as you think. And so this 18-month, 24-month refi concept may not occur. So if you're a limited partner out there and someone has brought you a deal to invest in, and you see in their prospectus that they plan on doing a refinance within 2 years or something like that, you're going to want to do this math to see if the ultimate rent growth is a head check. Does it even make sense? Because if all of a sudden I've got to raise the rent a couple of $100s for several years in a row, that's very unlikely to occur. All right, and not unless there's just massive inflation in the world, and there may be coming. I'm not arguing that one. I think there is going to be some inflation, but that's not a good way to try and run a business. We don't want to try and run our business gambling or just assuming we're going to get some kind of high-level inflation. So again, it's seasoning period. It's the valuation. We need the property to appreciate about 30%, and then we've got to do the math. You take the current NOI and you take the future NOI that gives us a 1.25 debt service ratio, subtract the 2 net operating incomes. What's the difference? Divide that by number of years. That tells us how much revenue we have to create per year. Divide that number by number of units, and that tells us how much we have to raise the rent per apartment or per unit per year to hit our refinance goal of 18 to 24 months. What you're likely to find is that it's not going to work, that you will actually refinance that property in, say, 3 to 4 years, not 2. So if you're planning on rent growth to get you into a refinance, it's a great concept. It's the BRRRR model. I think it works. I just think it's misunderstood and that people are trying to be a little bit aggressive out there, and they're projecting refinance deals that are not going to occur in that amount of time. There's only one thing that I would warn you about, and that is agency debt, Fannie or Freddie. These are long-term loans, and they can come with a lot of prepayment penalty, or what we call defeasance or yield maintenance. If you get into a long-term Fannie or Freddie loan and you expect to refinance in short order, chances are you're going to get hit with a big prepayment penalty, and that's going to take a big bite out of those profits. So if your plan is to go in, renovate an apartment complex, renovate real estate of any type, and then do a refinance within 5 years, I would recommend that perhaps agency debt is not the product you're looking for, because you're gonna get stuck with a lot of prepayment penalty. You want to go in and do a short-term loan such as bridge debt or something of that nature. It's going to have a higher interest rate, yes, but it's also going to allow you to exit the property without a massive amount of defeasance or prepayment. So this has been a quick rundown of about when you can refinance a deal. Wanted to break that down into some math. I think people just kind of make up numbers a lot of times because it's a good sales pitch. Hey, we're going to refi in 18 months and pull out all the money and give you back all your money and you'll have an infinite rate of return. Yeah, that's a great business model. I'm not saying it isn't. I'm just saying make sure that it will actually work, and here's the math to tell whether you're going to be successful and when you can do your next refi. This has been Bill Ham. If this has helped you, give me a like, give me a follow, give me a subscribe, and I'll be bringing some more information out shortly.